The bombshell announcement: Stellantis has just sent shockwaves through the U.S. auto market with a move no one saw coming, a sweeping round of massive price discounts across its lineup. This isn't just a small seasonal incentive or a limited-time rebate. This is a full-on, industry-shaking price slash that's forcing every automaker, dealer, and consumer to pay attention. Buyers walking into showrooms are being greeted with discounts that cut thousands of dollars off popular models like Jeep, Dodge, Chrysler, and Ram, making vehicles that were once out of reach suddenly within budget for millions of Americans. The timing couldn't be more critical, as the U.S. auto industry has been under tremendous pressure with rising interest rates, high car prices, and slowing demand weighing heavily on both consumers and manufacturers. By dropping this bombshell, Stellantis isn't just trying to spark sales, it's signaling that the traditional rules of pricing in the auto industry may no longer apply. What makes this announcement even more explosive is the ripple effect it's already starting to create. Dealerships are scrambling to adjust, rivals are monitoring their next moves carefully, and consumers are rushing to take advantage before the discounts vanish. For Stellantis, this isn't just a bold marketing play, it's a high-stakes gamble that could either catapult the company into dominance or expose just how desperate the fight for market share has become. Why Stellantis made this move? The question on everyone's mind now is, why would Stellantis risk so much with such aggressive discounts? The answer lies in a storm of challenges converging on the company at once. For starters, consumer affordability has hit a breaking point. With interest rates soaring and average monthly car payments reaching record highs, many buyers have been priced out of the market altogether. Stellantis knows that if it doesn't lower prices, sales volumes could continue to stagnate. At the same time, the automaker is facing intense competition not just from traditional rivals like Ford and GM, but also from Tesla and a wave of new EV startups that are rapidly eating into market share. Stellantis has been slower to roll out competitive electric vehicles, and by slashing prices on its current lineup, it's buying time and keeping customers engaged while it ramps up its EV strategy. Another critical factor is inventory. Many Stellantis dealerships have been sitting on lots packed with unsold vehicles, a dangerous position as consumer demand shifts and carrying costs climb. Discounts are a fast way to move that backlog and free up room for new models. Beyond that, Stellantis is under pressure globally. With the US being one of its most important markets, a bold move here could stabilize its financial performance and reassure investors. But make no mistake, this isn't purely offensive strategy. These cuts are also a defensive play, a sign that Stellantis is fully aware of the changing tides in the industry. If it doesn't act now, the company risks losing even more ground to competitors who are already experimenting with their own pricing strategies and EV dominance. In short, Stellantis is trying to rewrite the playbook before it's written for them. The biggest discounts revealed: when Stellantis pulled the trigger on this sweeping price cut, it wasn't just a symbolic gesture. The discounts are eye-popping and game-changing. Some of the deepest cuts are being seen in the Jeep lineup, where models like the Grand Cherokee and Compass are seeing thousands shaved off the sticker price, making them far more competitive in a segment that's been dominated by Toyota and Honda. Dodge is also in the spotlight, with heavy markdowns on the Charger and Challenger, cars that were already icons among enthusiasts but often priced out of reach for younger buyers. Now, with discounts running into the thousands, Stellantis is pulling in a whole new wave of interest from consumers who had previously walked away due to affordability. The biggest shocker, however, comes from Ram trucks. Full-size pickups have always been profit kings in the auto industry, and Stellantis is slashing prices on Ram 1500 models in ways that signal just how serious the company is about capturing truck buyers from Ford's F-Series and GM's Silverado. We're talking discounts so significant that buyers are reconsidering long-standing brand loyalties, with some switching to Ram simply because the deals are too good to ignore. Chrysler, too, is quietly benefiting, with family-focused models like the Pacifica minivan suddenly becoming much more affordable in a market where families are desperate for practical options without breaking the bank. These aren't token rebates or fine-print incentives that only apply under strict conditions. Stellantis is making across-the-board deals that practically force consumers to take notice. For many, this is the first time in years that car ownership feels attainable again. And that's exactly the reaction Stellantis wants: to reignite demand, fill showrooms with eager buyers, and make its rivals sweat as they watch customers flock toward vehicles that suddenly look like bargains. Immediate impact on dealerships: the moment Stellantis announced these sweeping price cuts, the ripple effect at dealerships was immediate and dramatic. Showrooms that had been eerily quiet in recent months suddenly saw a surge of foot traffic, with curious buyers rushing in to see if the discounts were real. Sales teams that had been struggling to close deals due to high interest rates and sticker shock suddenly found themselves fielding back-to-back inquiries, test drives, and negotiations. For dealers who had been sitting on massive inventory, especially Ram trucks and Jeep SUVs, the announcement felt like a lifeline. Vehicles that had been gathering dust on lots were now moving at a pace many hadn't seen since before the pandemic. But the reaction hasn't been universally positive. Some dealers are privately expressing frustration that these deep discounts, while great for moving metal, also slash into their profit margins and complicate long-term pricing strategies. A few worry that customers who purchased vehicles just weeks ago at full price will feel burned, leading to resentment and potential backlash. Others are concerned that once the dust settles, the expectation of permanent discounts could erode brand value, making it harder to return to higher pricing later. Still, most dealerships are seizing the moment. They know that in today's competitive environment, getting cars off the lot quickly is better than letting them sit idle while interest payments and overhead costs pile up. For many dealers, this bombshell move has turned a grim outlook into cautious optimism. And as buyers continue to flood showrooms, the question becomes, how long can Stellantis and its dealers sustain this pace before the financial strain outweighs the short-term sales boost? Competitors in panic mode. If Stellantis's goal was to put its rivals on edge, the strategy is already working. The sudden, aggressive price cuts have sent shockwaves through executive offices at Ford, GM, Toyota, and even Tesla. For years, these companies have carefully balanced pricing with profitability, trying to maintain strong margins while keeping vehicles appealing to cost-conscious buyers. But with Stellantis slashing thousands off its most popular models, that balance has been thrown into chaos. Ford, for example, has leaned heavily on the success of its F-Series trucks, but now faces a very real threat as Ram's discounts lure away longtime Ford loyalists. GM is also under pressure, particularly in the pickup and SUV markets, where Chevrolet and GMC could suddenly look overpriced by comparison. Toyota, a brand known for reliability and steady pricing rather than flashy discounts, now finds itself in a defensive position. Its buyers may begin questioning whether loyalty to Toyota is worth the premium, especially as Stellantis models like the Grand Cherokee and Pacifica are suddenly priced thousands lower. Even Tesla, which has dominated headlines with its own series of price cuts on EVs, must contend with the fact that Stellantis has widened the battlefield. By making its gas-powered vehicles drastically more affordable, Stellantis is pulling potential EV buyers back into the traditional market, stalling Tesla's momentum. Behind the scenes, industry insiders report that competitors are scrambling to evaluate whether they, too, will need to adjust pricing. But here's the dilemma: cutting prices on their own vehicles risks a massive hit to profitability, especially at a time when development costs for electric and autonomous technologies are skyrocketing. If they don't cut prices, they risk losing customers in droves to Stellantis. It's a no-win situation, and exactly the kind of disruption Stellantis was hoping to unleash. For the first time in years, the US auto giants are in reaction mode, watching Stellantis dictate the terms of competition. The consumer frenzy: the moment news of Stellantis's discounts hit mainstream headlines, consumers wasted no time flooding dealerships and online platforms to see just how much they could save. Families who had been postponing purchases due to sky-high car prices suddenly found themselves back in the game, with vehicles that once seemed completely unattainable now sitting within their budget. Social media lit up with stories of buyers scoring unheard-of deals on Ram trucks, Jeep SUVs, and Dodge muscle cars, fueling a frenzy that spread like wildfire. Word of mouth is proving to be Stellantis's most powerful marketing weapon. Customers are not only rushing to take advantage, they're dragging friends and family along, creating a snowball effect that's rapidly depleting inventory. This consumer surge isn't just about saving money, it's about seizing an opportunity that feels rare in today's economy. With inflation and rising interest rates straining household budgets, many Americans see these discounts as a once-in-a-decade chance to lock in a new vehicle at a price that actually makes sense. Dealerships are reporting record-breaking weekends, with lines forming for test drives and buyers even putting down deposits sight unseen just to secure their spot. For Stellantis, this reaction is exactly what they wanted: a tidal wave of demand that puts them front and center in the conversation about affordability in the auto market. But the frenzy has its drawbacks. Some dealerships are already running into supply shortages as popular models fly off lots faster than they can be replenished. Frustration is building among consumers who are arriving too late and finding limited options or stripped-down trims left behind. And as excitement builds, so does impatience. Buyers who can't find what they want at Stellantis may start demanding similar discounts from competing brands, putting even more pressure on the entire industry. What's clear, however, is that Stellantis has tapped into a deep well of consumer frustration and turned it into a powerful advantage. By giving buyers exactly what they've been waiting for, real affordability, the company has triggered one of the biggest surges in auto demand the US has seen in years. Hidden risks for Stellantis. While the headlines are celebrating Stellantis's bold price cuts as a win for consumers, the strategy carries significant risks that could come back to haunt the automaker. The first and most obvious is profitability. Trucks and SUVs have long been Stellantis's profit engines, particularly the Ram 1500 and Jeep Grand Cherokee. By slashing thousands off their sticker prices, the company is cutting into margins that fund everything from future vehicle development to dealer incentives. Short-term sales gains may look impressive, but if the discounts eat away too much revenue, Stellantis could find itself struggling to finance the very innovations it needs to compete in the EV and tech-driven future of the auto industry. Another hidden risk lies in brand perception. Deep discounts can create excitement in the moment, but they can also devalue a brand in the long run. If consumers begin to associate Stellantis vehicles with constant markdowns, they may delay purchases in anticipation of the next big sale. This expectation of perpetual discounts can undermine resale values, hurt brand prestige, and make it harder for Stellantis to command premium prices in the future. Competitors like Toyota and Honda have built reputations on price stability, and Stellantis risks being viewed as the discount brand rather than a serious competitor offering long-term value. Dealerships, too, face challenges. While they're enjoying a surge of buyers right now, the long-term fallout could include customer frustration from fluctuating prices, strained profit-sharing agreements, and uneven supply chains if Stellantis struggles to keep up with demand. Worse still, if the strategy fails to bring lasting momentum, dealers could be left with a yo-yo effect, short bursts of activity followed by painful slumps. And then there's the competitive risk. By making such a bold move, Stellantis has effectively declared war on pricing. If rivals decide to retaliate with their own discounts, the entire industry could be dragged into a brutal price war that leaves all players weaker. That's a dangerous game, especially in an era where billions are being poured into electrification, battery production, and autonomous vehicle research. Stellantis may have lit the fuse, but if the explosion spreads, they may not be able to control the fallout. Industry-wide ripple effect. Stellantis's bombshell discounts aren't happening in a vacuum. They're sending shockwaves across the entire U.S. auto industry. Competitors who have built their business models around stable pricing now find themselves under pressure to respond, and that's where the ripple effect begins. If Ford, GM, and Toyota decide to match or even partially match Stellantis's price cuts, the industry could be thrust into a full-blown price war. That would mean short-term wins for consumers but devastating consequences for automakers already stretched thin by rising production costs, supply chain instability, and the massive financial burden of transitioning to electric vehicles. Suppliers are also watching nervously. If automakers' margins shrink due to widespread discounting, cost-cutting pressures will inevitably flow down the supply chain. Parts makers, logistics providers, and even tech partners may face tighter contracts and lower profit opportunities, creating a domino effect of financial stress. Dealerships, meanwhile, could find themselves in a strange balancing act, reaping the benefits of increased foot traffic now but dealing with long-term fallout if discounts erode vehicle values and disrupt the rhythm of predictable sales cycles. There's also the impact on the used car market. As new Stellantis models become cheaper, the resale values of slightly older vehicles could plummet. This could upset leasing companies, rental fleets, and individual owners who suddenly find their cars worth far less than expected. It may even affect lending institutions, as banks and credit unions adjust loan terms to account for volatile vehicle values. Beyond the numbers, the move is reshaping consumer psychology. Buyers who see Stellantis offering massive discounts may begin expecting the same from every automaker. That shift in mindset could permanently change the way Americans approach car buying, not as a long-term investment but as a hunt for the next big bargain. And once that expectation takes root, it's almost impossible to reverse. In short, Stellantis hasn't just disrupted its competitors, it may have set in motion a chain reaction that alters the auto industry for years to come. What analysts are saying. Industry analysts have been quick to weigh in on Stellantis's bombshell move, and their takes are as divided as the industry itself. Some view the massive discounts as a brilliant, calculated strategy to seize market share at a critical moment. These experts argue that Stellantis has tapped directly into the pain point haunting consumers: affordability. By positioning itself as the automaker that listens to the customer and makes cars accessible again, Stellantis could win not just sales, but long-term loyalty from buyers who remember which brand gave them a deal when no one else would. Supporters of the move also point to the sheer volume of inventory Stellantis has been sitting on. With lots overflowing, slashing prices may have been the only way to prevent stagnation and keep dealerships afloat. But other analysts see a dangerous game in play. To them, the discounts look less like strategy and more like desperation. They warn that Stellantis may be sacrificing long-term profitability and brand equity for a short-term sales boost. Some even compare it to buying market share, a tactic that works briefly but can backfire when competitors retaliate and customers begin to expect discounts as the new normal. Concerns are also being raised about how this will impact Stellantis's ability to fund its electrification push. With rivals like Tesla, GM, and Ford pouring billions into EVs and next-gen tech, Stellantis risks falling behind if too much cash is burned on keeping prices low. Wall Street's reaction has also been cautious. While a spike in sales numbers could temporarily excite investors, many financial analysts worry about the sustainability of this approach. If quarterly earnings take a hit due to slimmer margins, investor confidence could waver, putting additional pressure on Stellantis stock. Meanwhile, industry veterans point out that carmakers rarely win price wars in the long run. It's usually the consumer who benefits, while manufacturers and dealers are left fighting for scraps. In the end, analysts agree on one thing: Stellantis has forced the industry into a moment of reckoning. Whether this move is remembered as a stroke of genius or a costly blunder will depend not just on sales over the next few months, but on how well Stellantis manages the fallout in the years ahead. Stellantis has thrown the U.S. auto industry into uncharted territory with these massive price cuts, and the ripple effects are only just beginning. For consumers, this feels like a long overdue win, a chance to finally get behind the wheel of a new car without drowning in debt. For dealerships, it's both a blessing and a challenge, bringing in record traffic while raising tough questions about long-term profitability. And for competitors, it's a wake-up call that the old rules of pricing may no longer apply. Whether this bold move cements Stellantis as a market leader or exposes cracks in its armor will be revealed in the months ahead. One thing is certain: the car-buying landscape in America has been shaken to its core, and nothing will ever quite be the same. If you found this breakdown insightful, don't forget to like, subscribe, and hit the notification bell so you never miss the latest updates shaking up the auto world. The story of Stellantis is far from over, and you'll want to be here when the next chapter drops.